Hey everyone, welcome back to Corporate Decoder. Today GS Group Incorporated, ticker GS, just filed an 8K reporting on their issuance of new debt securities, and there is a lot to unpack here about how they are funding their operations. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just sold hundreds of millions of dollars in new notes, and this tells us a lot about their financing strategy and the cost of borrowing. Alright, so what we're looking at here is a standard 8K filing. This kind of report is used by companies to announce major events that shareholders should know about. And in this case, the big news is about new debt the company is taking on. Goldman Sachs Group Incorporated, a giant in the financial world, has just issued a significant amount of new debt securities. This isn't just a small loan, they're talking about issuing $500 million in floating rate notes due in 2030, and then another $3 billion in fixed to floating rate notes also due in 2030. And to top it off, another $3 billion in fixed to floating rate notes due in 2034. That's a total of $6.5 billion in new debt. Let's break down what that means. When a company issues debt securities, it is essentially borrowing money from investors. These investors lend the company money, and in return, the company promises to pay them back with interest over a set period. The term floating rate notes means the interest rate on these notes can change over time, usually tied to a benchmark interest rate like LIBOR or SOFR. This is different from fixed rate notes, where the interest rate stays the same for the entire life of the note. The filings highlight a couple of different tranches of these notes. We see the 2030 floating rate securities and then the 2030 fixed floating rate securities with a stated rate of 4.594%. This fixed rate is what the company will pay until the rate starts floating. Given the current economic climate, companies often mix these types of debt to manage interest rate risk. Then there are the 2034 fixed dyed floating rate securities, which come with a 5.094% fixed rate. This means that for these particular notes, Goldman Sachs is committing to pay that fixed percentage for a longer period. Borrowing money for longer can sometimes come with a higher interest rate, which seems to be the case here with the 2034 notes having a slightly higher fixed rate than the 2030 notes. It suggests the market is demanding a bit more compensation for lending money to Goldman Sachs for a longer duration. The filing also includes legal opinions from Sullivan and Cromwell, a big law firm. This is standard procedure for significant debt issuances. It is essentially a legal stamp of approval saying that all the paperwork and the issuance itself is legally sound. And as you can see, the filing is formatted in IXB Abrel, which is the standard for digital financial reporting. This makes it easier for computers to read and analyze the data, but for us, it is just about understanding the core message. When a company like Goldman Sachs issues this much debt, it tells you a few things. First, they likely need the capital for strategic initiatives, maybe new investments, acquisitions, or to bolster their balance sheet. Second, it indicates their confidence in being able to service this debt. Essentially, they believe they can afford to pay it back with interest. Looking at the rates, 4.594% and 5.094% might seem high or low depending on your perspective and the general interest rate environment. For a financial institution like Goldman Sachs, who are experts in managing money, these rates reflect their creditworthiness. The fact that they are able to secure these lower fixed rates for longer terms, especially for the 2034 notes at 5.094%, is a testament to their strong financial standing. It is important to remember that these rates are what they are paying on newly issued debt. Existing debt or different types of financing might have entirely different rates. This move is also happening in the context of recent news about Goldman Sachs selling various notes. For instance, after this filing, we saw headlines about them selling $2.08 million in fixed rate notes at 4.75% maturing in 2031. This pattern of issuing different types of debt across various maturities, and rates suggests a proactive approach to managing their capital structure and funding needs in a dynamic market. They are essentially optimizing their borrowing costs and maturity profiles. So, what is the takeaway here? Goldman Sachs is actively managing its financing. They are raising substantial capital through debt issuance. The rates they are securing are competitive for a company of their size and reputation, but the sheer volume of debt suggests a significant need for funds to fuel future growth or strategic maneuvers. It is a calculated move that shows they are positioning themselves for what is next. The risk I am watching is whether the company can generate returns on the capital it is borrowing that exceed the interest costs. If they deploy this capital effectively, it will be a boon. If not, it could add significant pressure to their bottom line. Alright, that is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe to the channel for more corporate dives, and check out the Discord link in the description.